Hello, everyone. Hello. Welcome to this webinar today. How are you guys doing? Is everyone okay? Let's wait a few more minutes so everyone will get tuned and then we are ready to start. Guys, just to double check, is the voice okay? Everyone can listen clearly? Can you hear me clearly? Yes, thank you, Louis, for your response. Appreciate it. Hello, Mohammed, as well. Okay, so let's get started. Guys, just to make sure that this webinar is for educational purposes only, and it doesn't involve any personal financial advice. Now, what we will see today. Today, we will see something which is a really important aspect of trading profitability considering the losses, and that's the trading patterns. They appear on the charts. They appear again and again and again, over and over, in all time frames and in different market conditions. Buenas tardes. I don't speak Spanish, but I can read them. I like the language. So, and I noticed in my experience as a trader and educator that unfortunately many people, because they didn't taught to learn trading patterns, when it comes down to understand what the market is telling them, they are so focused only on one candlestick and they miss the whole picture which it was unfolding for some time ago on their chart. So today, I believe we're going to put an end to this and we will learn how to really read the market and how we take advantage of this trading pattern. And I will show you guys how you can actually trade these patterns. They are so powerful and it will benefit your trading a lot. Now, here at Admirals, we offer more than 8,000 financial instruments. We have license from major financial centers in countries like Estonia, like Australia, Cyprus, UK. Our spread are really competitive and you can take advantage of that as well. And you can access the trading platform through a web browser, or you can download them on your devices. It's the MT5 and the MT4 or MetaTrader. Now, just a quickly, we have a promotion right now currently, and the spreads, they have about 20 to 25% reduced. So please make sure you take advantage of that, especially if you are an intraday trader, which you want the minimal spread as possible. Now, if you guys haven't followed us on Instagram, please make sure so, because now we start uploading some reels for market updates. We also put a lot of stories about what's going on in the market, in the stock market, in the foreign exchange markets, and some trading ideas and so forth. So please make sure you can find us with Admirals Global on Instagram and just follow us. Also on Telegram, just search for Admirals, and I will make sure that I will put the links later on the chat so you can follow there. You will get notifications wherever we're going live. And most important, just go to the YouTube channel, press the subscribe button, give us a thumbs up as well, and you can comment on every video. I'm more than happy to answer any questions you're gonna put. Okay, so as for myself, my name is Theo. I'm trading more than 10 years now and investing. I hold a master in physics, and when it comes to trading, I'm a swing trader. especially now with the work schedule. I'm not an intraday trader anymore, and I'm an investing and trading educator exclusively for Admirals. What we're going to see today, as I said earlier, we're going to talk about the chart patterns. We're going to see how some chart patterns, they are behaving more as continuation. So they show that the trend is going to be continue, or they behave as reversals, and they give us an early warning about the trend it's over and it's about to finish. Also, we're going to explain how you can trade them and how you can measure your target with these patterns. Now, I would like to remind you something. I said a few times so far that these chart patterns, we find them in a trends. They're going to continue. They're going to show continuation of the existing trend, or they're going to show reverse sort of the existing trend. Now, the most important thing it needs to take in consideration is that we must have a trend for the patterns to be high probability patterns and to be valid. If we find any of these chart patterns just in a random area where the market is just chopping around and it's moving just sideways, these chart patterns, they do not have high probability success rate. So please write this down. For any continuation or reversal chart pattern to be valid and tradable with high probability reward risk ratio, it must to come prior a trend. Okay, so, but first, I will do something for first time today, and I will see, guys, if you're gonna like it. I will just take few minutes and I will review what we said on the previous webinar. Okay, because every webinar, it's kind of get connected with each other without saying that you cannot watch them as individual. Okay, but I try to make them in a way that they're going to have a sequence which it's going to help you to learn and be more consistent with your trading. So let's have a look. What did we said last time? Last time we talked about the trend analysis, and specifically I explained you in detail how to identify trends and where you can start trading this trend. So in an uptrend to be established, we need to see many buyers creating a move to the upside. And at some point, we want to see sellers to step in and try to push the market lower and make a retracement. Now, once we see that this high here, it's higher than this high here, we're going to wait for a retracement. And we hope that around the last swing, we call these swings, around that swing, we want to draw a horizontal line, and around that area, we would like to see the buyers step in again and rescue the market and push it higher. So once we establish this low to be higher than this low here, we do have a series of higher highs and higher lows. We see this impulse move, a new higher high in the market. We are in an established uptrend, and we're going to wait patient around this area, around the area of the last swing high, to take trades to the upside. And there are two ways we can participate in this trade. Either we have a limit order here, a buy limit order with stop underneath here, or second, we can wait for a price action here on a lower time frame. Let's say if you are a daily chart trader, you can go to the 4-hour chart and you can either find a strong reversal pattern, as I told you many times, bullish engulfing or bullish pin bar, and you take the trade to the upside. So you can use tighter stop. And The same but opposite, it applies to the downtrend. We have this move to the downside, then buyers, they stepped in, they push for a retracement. Now the market creates a low here, which is lower than this low. So we identified the first lower low. Buyers, they stepped in, they tried to buy, then the sellers, they start selling, and then we see the swing in the market. And then we have this low, this high here, it's lower than this high here. So we have lower low, lower highs. What we want to see the sellers make an impulse move. We are ready around this area here. If the market push back and make retracement, to participate on the downside. Okay, and I told you about the trading execution high probability checklist that I personally use for years now, and I just give it to you guys. You can write it down, or you can take a screenshot of this chart, and please try to implement in your trading. It's gonna help you a lot. So what I do, I open the weekly chart and I map the market. I draw support and resistance areas, try to identify what the market is telling me, if it's in a uptrend or in a downtrend or in sideways, just to understand what's going on there. Now, sometimes we said that candlestick, they are chopping around, very messy, so we can use the line charts to see the swings only without any wicks in the market. So it's easier to draw support and resistance. Then we go to the daily chart and we try to identify the areas of retracement. We are staying patient. We say that, okay, that's where I want to sell the market, or I want to buy the market. So I'm patient there. I'm waiting for the price to come to that area. And if we want, we can go down to the 4-hour chart and trying to find precise entries using either the chart patterns we're going to learn today, or the existing candlestick patterns we know, the engulfing and the pin bar for high probability trades. And in regards to target and stop loss placement, I always make sure that I'm making at least 2 to 1, so the probability is going to be always in my favor. Okay, now in regards to the chart patterns, when we have a trend, a downtrend or an uptrend, at some point these moves, they're going to finish. Early warnings about the end of an uptrend or a downtrend, we call them reversal chart patterns, and we're going to see them in a while. But in many occasions, we also have some patterns, they appear on the chart, which they are telling us that the move is about to continue. So these patterns, we call them continuation patterns. And as a rule of thumb, continuation patterns are shorter in duration than reversal patterns. Reversal patterns, most of the times, they take longer time to be completed than the continuation patterns. So let's start with the continuation patterns. First, we have the symmetrical triangle. We see the market is making higher highs. We see this high here, it's higher than this high. And then we are waiting for the market to come here and participate in the move. Now, we see that the market is trying to come to push higher, but unsuccessfully, it doesn't break this high point. It doesn't make a higher high, and it pushed backwards. And at that point, we are confused as traders. We don't know what's happening, and it's normal because we don't have a clear picture. But when we see that at this point here, market reversed to the upside, we have 2 points. So any line can be drawn with 2 points, with 2 dots. So we take these swings and we draw this upwards trend line. And then we see that swing here with that swing here, and we had our trend line sloping to the downside. And then the market, surprisingly, on this second attempt to push higher, it just stopped and reversed, and it stays within this triangle formation. So at this point in time, we just see the market with this strong impulse move. We see that the market is trying to push higher, but the sellers, they stepped in. But the sellers, they are not able to create lower lows. But the buyers, they do something significant. Every time the market is trying to push lower, they stepped in at higher price than the last time, and they are buying. They buy higher than what they bought here, and here they buy higher than what they bought there. So this is an indication of buying pressure. So we call this symmetrical triangle. When we find it in an uptrend, it has bullish implications, and the most reliable triangles, and in general, the most reliable chart patterns, in my experience, are found on the daily and on the weekly charts. If I see a triangle formation, symmetrical triangle on the 5-minute chart, I'm going to question its reliability. If I see it on the 1-hour chart, I'm going to question if it's a reliable chart pattern. Then we have to go back to the higher time frame to do analysis and understand where the market is moving at the point in time, and to see if there is a logical reason why this triangle is there on that smaller time frame. So I stick to the daily and weekly chart patterns because they are the most reliable in general. Then when we are in a downtrend and we see that the market is trying to push lower, but it cannot create a lower low, then the buyers, they try to push higher, but they cannot create a higher high. And then the market, it's again trying to push to the downside. We can draw these two trend lines here, and then we see that the market, it bounced for third time here and there, another 2 bounces. We identify this pattern after the completion of these 2 swings, and after the completion of these 2 swings, towards the end, we identify that it's a symmetrical triangle because of the shape, and because we found it in a downtrend, it has bearish implications. And again, in terms of reliability, I consider the daily and the weekly chart as the most reliable. Now, how can we trade them? After we identify the pattern, I go back to the bullish symmetrical triangle. We can measure, I didn't draw it here, but let me take you to the whiteboard just for a sec. So we are in an uptrend. Can you guys see where I'm drawing here? Can you please type a quick yes? So to make sure that everyone can see the screen. Okay, thank you so much. Thanks everyone. So after we see this move and we identify that we have a symmetrical triangle pattern, and we understand that it has a bullish implication, so we want to participate to the upside, usually the pattern is going to break. Usually it's going to come to retest the broken level, and it's going to move in a distance at the least once up. Sorry guys, let me change color. So this is the height of the pattern from where it started until the base, as we call it. Okay, so this move here, this distance here, we replicate it. So totally equal distance. This is the minimum implication of this pattern here. So after the break from this point, we usually we see the price move at least the distance from the top point to the base, and that's for all the symmetrical triangles. If we are in a downtrend, which we're going to see now, and we have this this symmetrical triangle here, after the break, if we have this as the base, the market usually it's going to give at the least one run equal to this distance here. So if the market is going to come up to here and we can wait for a pullback, we can get an entry here, we can put our stop somewhere here, and then we have a good usually more than 1-to-1, 2-to-1 reward to risk. Okay, guys, everyone understand this? Did everyone understand what we just said? That's awesome, perfect. So we keep moving to the next slide. Now we have the ascending triangle, again, continuation pattern, and the descending triangle. The ascending triangle, we find it in an uptrend and it has bullish implications, and the descending triangle, we find it during a downtrend and it has bearish implications. So the market is making higher highs, coming back. Until this time, everything is fine. We just treat it as an uptrend, and we try to move to the upside, and exactly at the last swing high, we see the sellers push the market lower. Once the sellers, they start push the market lower, we don't know what it's going to happen, if this is going to come all the way down to this swing low. That's why at this point in time, we do not have enough information to take trading decisions. We wait to see what the market is going to do. Is it an ascending triangle, or is it going to be a double top reversal, which we're going to learn in a while? So we don't do anything at this point. As traders, we are patient to see what is going to happen after the finish of this decline. And we see that at some point higher than this point here, the buyers, they stepped in and they start buying. Once we see this swing here, we can draw our trend line. Because we have these 2 points here, we can draw a horizontal line as well. So we are at this point and we see that buyers, they stepped in and they bought higher than what they did previously. So it's the first indication that this market, it has a tendency to keep pushing higher. Then a third attempt by the buyers to break the last high or the last highs, and it follows by sellers trying to sell this market. Now we have to be very, very, very observative here. So we want to see the market stop somewhere around the trend line we already draw. So on this, at this trend line, the market make this push to the upside, and now we have a high chance to see this market breaking above this resistance, because for third time the buyers, they stepped in and they start buying higher and higher than what they've done previously. So we call this ascending triangle. After the break of this resistance, we expect to see the market push to the upside and make minimum distance from this point to this point. If we measure this and we replicate it here, that's the minimum distance we will most likely see in the market. Then we have the descending triangle. It's the same skeptical, but in the opposite trend, in a downtrend. We see this lower low, we know we are in a downtrend, so we want to find ways to get into the downside. And sometimes the market, it's not going to just keep moving like this in a straight lines. It's going to do this sideways, but with respect to the bigger picture. And that's where we find this type of patterns. So the market at this point in time, it's showing that we're going to trade to the downside. And then at some point here around the last low, we see that the market is not breaking and the buyers, they start pushing higher. Then we see the sellers at this point to step in and selling from this point here. Then we can draw the line because we have 2 points of reference, and then we have 2 points of reference here. We draw the trend line and then the horizontal line, and we want to see the market for either third time or just to see the break from here or to see another bounce on the trend line. Either way, after these 2 successful points swings in the market, then we map the market and we want to see break to the downside. And we can measure this distance from this point here to this point there, and that's the minimum target for this chart pattern. All right, guys, is it clear? Is it understandable by everyone? If you guys have any questions, please just type them on the chat box. Now, another continuation pattern we find very, very, very often is Jacob asked, do you wait for the pullback to enter? Yes, I do wait for the pullback to enter. However, I missed trades by waiting for the pullback, but because that's what my trading plan is, to wait for the pullback and not just getting right on the break. Yes, sometimes I miss trades. So another question, do I need to look at the shape of the candlesticks that's inside the patterns? Inside the pattern, Remo, actually, this is a great question. First, the big picture of the market is the patterns, and then we zoom in to see each and one in candlesticks, what they say, because let's go back just for a second. Let's go back to the whiteboard. So here, 1 second, guys, let me just. Okay. So Remo asks, do I need to look at the shape of the candlesticks inside the chart patterns? Let's say we have this bullish pattern and we see this triangle here. Okay, so let me just make it a bit different. Let's see, we have this ascending triangle. Okay. Now, okay, that's better. So ascending triangle, we said that has bullish implications. So we're going to look for buys. Now, at this point here, let's say we have this pin bar, okay? And then we see a candle open here, make all the move here and close there. If we look the candles within the patterns, it's normal to start question the pattern from this point here to there and from this point here to there, because our focus, it goes away from the big picture and it just narrowed down to a specific candlestick. And that's not real, because maybe it was a news event here that created this one candle move to the downside. Okay, so this one particular candlestick cannot change the whole picture of a pattern. And in order to have to be patient, and in order, first and foremost, not to question the pattern we see, we have to distract ourselves from the individual candles within the pattern. The only way you can watch the candles within the pattern is if you're going to decide to trade within this pattern. If you see sorry guys, I've done something here and I think I lost the whiteboard. Okay. Okay, let me share this whiteboard then. So we are moving like this. The only way to see the candles within the patterns and pay attention is if you're going to decide to trade them. Okay, if you decide to trade them, then you find a pin bar here. You are very aggressive, and then you say, okay, I'm going to trade from here to there. That's the only way you need to look at the candles within the patterns. So let's go back to the PowerPoint. Next continuation chart pattern is what we call flag and pennant. Usually we find them in an uptrend. Of course, we found them in a downtrend as well, but I mostly see them in an uptrend. Okay, when we see them in an uptrend, of course, they have bullish implication, and we're gonna see them after a big, unusual impulse move. I say unusual, and you can see that I make a way longer in duration impulse move here. So it's easy for your eyes to spot it. And after this, you're going to see a tiny consolidation. It's not going to last for a long time. And then the market is going to break to the upside. It's not going to even retrace back to the last swing high. So, or if we're going to see the pennant, we're going to just see the market moving a little bit sideways like this, and then with a slope to the downside, and then we're going to see the break to the upside. So, and both of them, they have the implication, as we said, bullish, and they are very, very strong and reliable continuation patterns. All right, guys? Now, let's have a look at some reversal patterns. These patterns, we call them double tops and double bottoms. Among the trading community, these are the most tradable patterns, the patterns that they appear more often than anything else. And they have very, very, very good high probabilities setups when they appear on the daily charts and on the weekly charts. Mohammed asked, what is TP and SL? TP stands, let me write it down for you. TP stands for take profit, and SL stands for stop loss. And these are orders we put in the market when we enter in any trade. So to take our profits and to get out. Sorry, TP and flag. Are you talking about, Mohammed, are you referring to this particular slide here? Take profit for, okay, that, yeah. All right, so Mohammed is asking, what is the take profit and stop loss for these particular patterns? Again, because we have this symmetrical triangle, we can measure this distance here to this distance there, and from the break we expect to see a move at the least equal to this one. Usually this type of patterns, they give twice the moves, but at least we expect to see once this distance. And the same from here, from this point to this point here, we expect to see the equal move to the upside. Now let's talk about these reversal patterns. You are welcome, Mohammed. The double top and double bottoms. Double top is a chart pattern. We find it in an uptrend, and it has bearish implications. It has a reversal implication. That's why they consider as reversal patterns. Now, let me walk you through this example here. At this point here, we have a retracement. We don't, let's say that this one, it's just a move to the upside. We don't know from where it came from. And we just start observing this price and this market behavior. We see the impulse move, and then we see this retracement, and we say to ourselves, if we're going to break above this high and the buyers, they're going to push the upside, then we are in an uptrend and we want to participate in this uptrend. And what we can see here is that the market make a move to point A. So we have this high, it's higher than this high, so we have a higher high. And at this point in time, everything is bullish. It's a valid uptrend. At point B, it's an area of interest, and we can start buying this market because we are in an uptrend. Regardless, now you see this pattern in front of you that it's ending up to the downside, and it's changing from an uptrend to a downtrend. At this point here, we don't know what is going to happen. So at point B, we start buying. And that's why many times, and if you are watching my webinars in the morning, I always say we make sure that at the last swing, we cover ourselves by taking either our profits or by go on break even and lock some profits, because we don't know the market, what it's going to do when it's going to revisit the last swing. Maybe the sellers, they are ready to step in with massive orders and completely change the direction. So we have to be prepared. Now, at point C, the market is making a move to the opposite direction. And we can only understand that either we're going to have a consolidation like a ascending triangle formation, or the market is going to just move sideways, or at some point it's going to break. We don't know. The only thing we know is that we see the market rejected at point C, and it's pushing to the downside. Now, at point B, it was the point of reference, as we call it. It was the last swing low. When we see the market break and penetrate this point B and close below, and we have a lower low in the market, we have a lower low than this low here. So the uptrend is done, it's finished. Buyers are not in control anymore, at least at this point. So what we can start looking for, we can start looking for a retracement around the point, the last swing B. So we call this, if the market comes to the point E and we see some sort of rejection, and we take trade to the downside. So, but again, guys, the most important, and this you have to understand more than anything else, for any of these patterns to have high probability setups, they must come from an established uptrend. If we do not have an established uptrend, these patterns are not reversal patterns with these high probability implications, because they don't have something to reverse, a reversal pattern. It's a pattern that comes prior an uptrend, let's say a reversal double top, but it has to reverse the uptrend. So it has to reverse the existing trend and create a trend to the opposite side. Did we understand this? Does anybody, does anyone don't understand what I explained? Please make sure first you identify your trend and then look for the patterns. If we don't have a trend, we don't have a reversal pattern. We don't have something to reverse. I have a few questions here. Double bottom, Marcio, we will see double bottom just in a while. Remo, what if point E move beyond point B and C? Is still valid trade? Remo is asking, what if point E move beyond point B and C? That's a great question. If Mario is asking if this price, as it comes to the upside, if it doesn't stop and show some reversal signal at point B and it's keep going to the upside and it makes a higher high, so a high which is going to be higher than point C or point A, of course, we are in an uptrend. We are in a new uptrend. And we're going to start looking for ways to trade to the upside because that's what the market show us it's going to do. It doesn't mean because the market make this lower low, it's 100% double top reversals. If by any event the market decided that they're going to push it to the upside from this point here without stopping, without reversing anything, and let it be. That's why we said we are patient and we monitor price action when we identify the pattern. And some patterns, they are failed patterns at the end. It doesn't mean they're going to work all the time. Okay, they fail, but most of the times they do work and they work really good on the higher time frames. Double bottom, ABC. Yeah, I should have the letter B here and then the C here. That's a good observation from Marcio, and thank you so much. I will change it on the slide. Then let's have a look at double bottom. The market is moving to the downside. We have a lower low, and then at some point it retraced back. Sellers, they stepped in, they sell, and at the last swing low at point A, the buyers, they stepped in and they pushed this to the upside. And at point D, they create a higher price than point C. So we have a higher high in the market. We call this neckline, where I have the dotted line, we call this neckline. And then the market is pushing lower. And at point E, we can find a nice entry and take it to the upside. Again, if at point E, the market doesn't stop with a reversal price action, then we have to question this pattern. And if, of course, the market, it comes and retrace all the way down to this level here and penetrate it, of course, we are in a new downtrend and we're going to find the ways to get to the downside. It means that the pattern failure, that it's a double bottom failure pattern. Same with this one, as we just said. But most of the times, these are very reliable signals. And then the last very, very important reversal chart pattern is the head and shoulders if we are in an uptrend, and the inverse head and shoulders if we are in a downtrend. Let's go quickly through them, and then I will walk you through some live chart example, guys, so you can see in reality. And actually, I found trades that I took on the higher time frames. Some of them are years ago, and I will show you I will walk you through all the thinking process I've done. So let's see the head and shoulder. It's one of my favorite chart patterns because it takes a long time to create it, but once you identify it on a daily chart, the head and shoulder, most of the times it's a great chart pattern to trade. So market is making higher highs at point C. This the point C is higher than the point A. So we're going to wait for the market to come to retest the point A before we start looking for longs. But surprisingly, the market penetrates the point A, which it was the last swing, and it comes all the way down, almost retest the point B, just slightly above. At this point, we are still making higher lows, so we have higher high and we have higher lows, so we still have bullish implications. However, we don't trade it because this retracement is so deep, and the buyers, they should step around here in the middle to buy and push the price higher. Now, the market start pushing higher from point D, and at some point along the way, we see that the sellers, they stepped in and they start selling. Now, once the point D penetrate and we have a new low in the market at point F, then we can take this as our new downtrend, because we have at D a low and at F a lower low. We have at C a high and at E a lower high. So we have a lower high and lower low, and we treat it as a downtrend. We're gonna be patient, wait. If the market, usually it's going to come back to point G, where it was the penetration of the neckline, and we can initiate positions to the downside. And the implication, the measure implication of this pattern here, this is the head and shoulder. So we measure this distance and we replicate it. Okay, so let's assume it's not exactly the same, but let's assume that this equal to this distance here. So if we enter somewhere here with a nice bearish engulfing or pin bar price action, it means we can use tight stop entry, let's say here, and we have much room to go until the minimum measuring of this pattern. Okay, so let's go back to the PowerPoint. Then on the contrary, we have the inverse head and shoulder. We find the inverse head and shoulder in a downtrend, and it has bullish implications because it shows control by the buyer. So the market is coming down at point A. Then, excuse me, I will tell you that the point C, we call it as a head. The point A, it's the left shoulder, and the point D, it's the right shoulder. That's why we call it head and shoulders, because it has two shoulders and it has the head, and it's like the shape of our body with the shoulder, the head, and then the other shoulder. So on the opposite side, we have the market moving and downwards, creating a swing here, push to the upside, then a lower low. At this point, everything is good. We want to sell it, but surprisingly, we see a deep retracement and retrace almost back to the last swing, which is the point B. Then the market, the sellers trying to push. We don't participate in this move because still has bearish implication, but it's not a high probability setup. So then the market is trying to push lower, and around the last the swing of the point A, usually it's around here. When it happens in the market, buyers, they stepped in and they penetrate this neckline, and they create this higher high, this high, which is higher than this high at point F. Then we have this higher high, we have this higher low, so we can have our trend line. The market is in an uptrend. We wait for a pullback at point G, somewhere at point G, and then we take this trade to the upside. Okay, guys, and this is the inverse head and shoulder. If we measure the distance from this neckline down to the head, this distance here, and we replicate that here. It's the minimum travel distance of the price, and most of the times this pattern really well run this distance. Okay, now I will go to the MT5 platform and I will show you some patterns. First, because it's fresh in our head, I will show you the head and shoulder reversal pattern. That was a trade I took in 2017, and you can clearly see why, because we have the market making a high here. Then if I flip it to the line charts and change the color to black, I think it's going to be better. So we have the market making a high here, and just 1 second, guys. So the market makes a high here, and then we have this trend line here, and the market makes a lower low. At some point, the buyers, they stepped in, they tried to push the price higher, and then the market make this lower low here. So we have this lower high and lower low. And if we go back to the candlesticks, and I zoom in a little bit. So I was waiting patient. After I see this lower low here, I identified that that was a head and shoulder because of this head, left shoulder, right shoulder. And let's put the last swing, it was somewhere here. It was somewhere there. So I said to myself, okay, I will see if the price comes somewhere here. It came with this bearish engulfing candle. First this inside, then this bearish engulfing. And I entered here. I had it stop about 50 pips. I remember that was 44. I took about 50 pips. And then I took, I think it was 4-to-1 trade. I took it somewhere there around 200 pips. So this one here, it had a measure implication. This is our trend line. This is our neckline, excuse me. This is the head. It's about 320. From the moment it broke, it gave 390 before it reversed. So it gave that 1-to-1, more than 1-to-1. Okay, that was one example. Then this one here was an inverse head and shoulder pattern. The market was coming to the downside. Here, this was tradable around this low point here. The market hovered around and then it started pushing to the upside. The sellers, they tried to take control, but they left with 2 candlesticks in a row, and this is a daily chart. Okay, for 2 days in a row they left these tails here, which indicates rejection. So we have and then from here we see the market pushing to the upside. So I saw that, I said to myself, okay, this is a head, this is a left shoulder, this is a right shoulder. So we had this broke here, we have this retest, and I was in this move, and it gave at least 1-to-1 until it retests this level here. Okay. Let's go to the next one. I think that was only from this one. A recent example in 2022 was, let's go to the double top first. I think it was, we had 2 here, double tops. We have an uptrend. You see, guys, this is an uptrend, established uptrend, strong impulse move to the upside. The market tried to retrace, and then the sellers, they stepped in and they tried to push the price lower. So we penetrated this trend line, this headline, this neckline here, excuse me, and then the market pushed lower And on the H4 4-hour chart, we had this retest here, and then it pushed to the downside. So that was a double top. Another successful double top. We traded, it was back in 2017. Guys, I'm showing you the clearest examples out of all these trades. Okay, so the market was moving to the downside. We see here lower, this not lower low, so the move stopped somewhere here, and then we were sitting patient around this area here. And at this area, what did I spot? What did we spot? We spot this trial from the buyers to the upside, and then this bearish engulfing candle. The buyers, they tried to penetrate, but on the same day they got reversed by sellers. So an entry here, it stopped there, and somewhere here it was well more enough than 5 or 6 to 1. That was a great trade as well. So and then we had an ascending triangle on this pair, the USD Japanese yen. You see the market was in an uptrend, making higher highs. Then the sellers, they tried to push the price lower. Then the buyers, they stepped in and they bought higher at this point here. And then we had this rejection. So after we see this rejection, we can draw our trend line up. We can draw the trend line here. We connect 2 points. Then we saw this double rejection here, so we could draw our slope upwards trend line, and then we were waiting to see a break away from this area. Now, for this market here, we didn't have a retest, and I go back to the question. Let me find it. Jacob asked, do you wait for the pullback to enter? And I do personally, I do wait for a pullback, but I have many friend traders where they just put their buy stops here. They have their stop loss below on the other end of the pattern, and they just wait for the move to take them into the new trend. So in this case, that was working absolutely fantastic. And a descending pound usually is famous for the flag and pennants. We see this impulse, and then we see the market slowing down without clear intention from the seller to push lower, and then the market break to the upside. That's the pole, and that's the rectangle in the middle. Then a recent example, it was this, and the last one for today, it was this descending triangle. We are in a downtrend, so we have this low is lower than this low here, or this low, whichever you see as a more reference. So we have a lower low in the market. Buyers, they stepped in, they tried to sell, or they trying to push the price beyond this area here, beyond this area, which we had the rejections. So the sellers at that point, they stepped in and they pushed the price lower, and the buyers, they stepped in here. Now, I go back again to another question from, let me find it. Do I need to look at the shape of from Remo? Remo asked if it's important to look the shape of the candlesticks inside the pattern. Now, this is a very, very good example. I guarantee you guys that if someone is looking the candlestick shape around the inside the patterns, when you see this bullish engulfing here, the only thing you're gonna start doing is buying. Why? Because this candle, it's so long, considerably with any other recent candles, and we can say to ourselves, that's a double bottom. That's a double bottom. So we can start buying. And that's a reason why we avoid immediately to buy on the double bottoms, and we wait for the price to break through the neckline, which it could be here in this scenario. So the market, after this move here to the upside, it's losing the buying pressure momentum from the seller, which they end up pushing the market lower. Again, in this example, the market broke below, didn't even look back. If you had an entry here and a stop, let's say 130 pips, you could make more than 3-4 to 1 trade. Sometimes we're gonna get it right when we wait for the retracement. Sometimes the market is gonna just penetrate the support or the resistance and never look back. Okay. Guys, any questions, any comments, anything you want to ask me at this time? Please type any questions you may have. Did you find this session helpful? Yeah. Oh, good. Okay. That's great. Okay, guys. So that's all from me today. Please open your charts, go to the demo accounts and try to identify these patterns. And if you want, send us some emails about what you've experienced yourself. Maybe it's something you want to ask. If you have any questions, after the end of the webinar, you're going to receive a questionnaire, some feedback. Please fill it up and send it back to us. Thank you all for your participant. Really appreciate it. It was a pleasure to have this session with you guys. I'm looking forward to see you tomorrow at 9:30 for the morning briefing market analysis. And I wish you happy trading and happy evening. Thank you so much.